Welcome to Full Speed Ahead. I'm Craig Fuller here with the CEO of Echo, Doug Waggoner. Doug, how are you?
Great, Craig. Thanks for having me.
Well, I think the last time you and I spoke was about a year ago. The world had just recently shut down. There's a lot of questions about sort of the future of the economy, the future of logistics. We now have the benefit of hindsight. How would you talk about the industry right now?
It's funny, I was just talking to our new hire class about an hour ago, and one of the questions was, what have you learned through COVID? And I'll tell you what, if I go back a year ago, coming out of April when everybody shut down and we had to send everybody home, we had about a week of panic wondering, how are we going to do this? And our business volumes ever going to return? And daily meetings, with the executive team, just planning for the worst and hoping for the best. And so, by the time we got to June, about a year ago, everybody was coming back. The small businesses were reopening. They were selling all their products. They were running out of inventory. Their suppliers were out of stock. And we just saw this huge demand for freight. And I attribute a lot of that to the fact that people were staying at home and they were buying products and not services, and that fueled the freight economy. And then I think about the same time we started recovering from the industrial recession, and that was an extra boost. And then all the stimulus spending that the government's had, we've just seen a tremendous freight economy over the last 12 months. And when you combine that with tight supply of capacity and the driver shortage, I think a lot of the new Class 8 truck purchases that we're seeing, and from what I hear talking to trucking companies, are purely replacement equipment. And so it doesn't appear to me anyway that the industry is adding any capacity. And then when I look forward, I think, okay, the inputs are all still very bullish, right? We have continued stimulus spending. We have continuing improvements in demand. People are getting back to normal. You've got the potential for infrastructure spending, and so many things that are going to help the demand side of the equation. And I don't see any relief in sight on the supply side. So the big learnings for me was we could do business in a different way. Sending all of our employees home, and now we're having trouble getting them back because they like working at home. But we've also proved that we can do it. So as we look forward, we think about new ways of doing business that are, a little more innovative than what we thought we could do in the past. And I think a lot of things are possible.
Yeah, it's interesting you mentioned sort of the cycle that is freight, but also the tightness of drivers. I've heard that some of the fleets not only can't get new truck orders, but are actually selling, they have empty trucks because they don't have drivers for them. So they're actually selling them at a premium, which is sort of helping their balance sheets, but it's not bringing additional capacity in the market. This cycle, trucking, I've been around it my whole life. You've been in it for many, many years. Everyone says this cycle is different. I've heard that almost every time something slightly changes in the market and carriers have the advantage. Do you think the cycle is different this time?
I do. In most cycles, if you just take 2018 and going into 19, I mean, we came out of, at the end of 2017, we had the two hurricanes, the big one in Houston and a smaller one in Florida. And that disrupted the national network of trucking capacity. And when those disruptions happen, where people can't get into Texas and they can't get out of Texas, it takes months to work that off. And then that was exacerbated by the ELD mandate that we had in January. And so I would describe 2018 as, decent demand, but curtailed supply of capacity because of the disrupted network and the ELD mandate. And, that started getting worked off as we progressed through 18, those tight market conditions kind of worked their way out. And at the same time, I know that we had done a survey of small trucking companies because we were trying to ascertain, how much capacity have you added, if any? And I think we surveyed about 5,000 small trucking companies, and we got responses from 800 of them. And on average, they added 11% more trucks. And even the big trucking companies who were publicly saying they weren't going to add capacity and they were going to have discipline and and toe the line and keep the prices elevated. We later figured out that, oh yeah, they did add trucks. Fast forward to today, I don't think anybody's adding trucks. Just anecdotally, I was talking to a woman a couple of months ago who has a small trucking company in Illinois. She has 6 trucks. Her and her husband have a steel distribution business, and they started the trucking company to move their own steel to their customers. But they also do work for other companies, and they deal with us and other brokers to get deadheads to get their drivers back in position. And I was talking to her, and I said, how's business? And she said, well, she goes, I have 6 trucks. She says 3 of them are parked because I can't find drivers. And I talked to some larger trucking companies this week and said, what's going on with capacity? And I see all these big Class 8 truck orders, and they said, yeah, we have the newest fleet we've ever had, but we haven't added any additional capacity. I think one of the things that happened during the year of COVID was that the driving schools shut down. And so, some of the larger trucking companies that get 30 or 40% of their drivers right out of schools, lost that pipeline. And so, I saw one of the sell side analysts last week made a call that, the driving schools are now 70% capacity, headed to 100, and that's going to solve the problem. But I don't think it is. So back to your original question, is it different this time? I think it's different because I see a prolonged economic recovery, and I see no end in sight to the driver shortage.
Yeah, it's certainly a tough time. Bloomberg did an article yesterday, in fact, or this past week, where they covered the shortage of gasoline supplies in Colorado because the tank truck operators can't get qualified drivers to drive tank, and they actually reached out wanting a quote on why it's hard for tank truck operators. And I was explaining to them that those hazardous material certifications just create an additional supply constraint on an already tight driver pool. And there doesn't seem to be a very quick answer. But this is labor supply issues are across all industries, whether we're talking about pilots, where the local Panera that's across the street from our offices doesn't open their dining room during the day because they don't have workers. Doug, this seems like a real fundamental issue that could stunt the growth of the overall recovery. How do you see it?
I think you're right, Craig. I see it everywhere. When I go to a restaurant nowadays, I'm always stunned by the lack of service, and it's usually because they're shorthanded. I've seen some chatter, out on the internet from employees, not necessarily Echo employees, but just in general, that McDonald's is raising minimum wage to $15.50 an hour, and that works out to about $32,000 a year. If somebody's contemplating a starting position in the industry that pays, say, $40,000 to $50,000, it's not significantly higher than McDonald's. So there seems to be a lot of consternation with employees. There was a Wall Street journal today, I think, that talking about employees not wanting to return to offices and also contemplating job changes. And so it's just a very unsettled time. It's tough to find people, whether it's technologists, software engineers, or even, salespeople. The market's competitive. Here in Chicago, you've got lots of startup companies, you've got lots of tech companies, and they're all hiring. So I think we have an employment situation, and I think we're also going to have some wage inflation.
Now, what are you guys seeing as it relates to Echo in terms of, is it harder to recruit today in terms of getting candidates into your operations? Are you guys open to work from home? What's the situation right now as it relates to Echo?
So, we do a lot of college recruiting, and of course there's always a fresh crop of college graduates, and we recruit on 200 campuses. So we continue to see an influx of people. In fact, we just started a class 2 weeks ago that's got over, I think, about 95 people in it. That being said, all of those people that we are recruiting seem to have more options today than they had in the past. They're looking at multiple job offers, and they're trying to pick which one is the right one for them. We've continued to work remotely. Last June of 2020, we told our employees that returning to work was optional. And some people did return to work, not a lot, but some. And, as we go forward, we've thought long and hard about, what are we going to look like in the future? And part of us, feels like we need to be more flexible because we've proved that it can work, and it's worked very well. We've had a lot of growth this year and a lot more volume and a tight market, and everything we're doing is harder, but yet we're doing it from home just fine. But on the other hand, when we hire on average 60 people a month, we think there's tremendous value in immersing those new people into our culture, and it's hard to do that on a Zoom call or a Teams call. We think that there's a lot of value in what I call peer mentorship. And so, we do have a return to office plan that starts in July, pretty gentle. It starts out at 2 days a week, and if you're new at the company, it's more, but if you've got tenure, it's 2 days a week. And in September, it moves to 3 days a week. And we're kind of taking a wait and see attitude to go beyond 3 days a week. But we also believe that in the future, we're going to have more flexibility. And so if you've got tenure with the company and you're a high performer, you're going to have a lot more options available to you.
And Doug, what does this mean for cities like Chicago, which have a large pool of transportation logistics expertise, or even more meaningful to Chattanooga, which, logistics is a big industry here? There's a lot of questions locally in Chattanooga about whether Chattanooga, frankly, can survive in terms of hosting headquarters because the wages have gone up so significantly as companies have started out of San Francisco and New York and Chicago have started to pick off local talent. Any thoughts on what this means in terms of how communities are going to shape themselves in a post-COVID world?
Well, speaking for Chicago, Chicago is quickly becoming a tech city, right? We've got right here in town, we've got Google, we've got Uber, we've got Facebook, Grubhub. We've got a number of established technology companies. Plus, we have a very active startup community, and there's a lot of venture capital investments, not only from Silicon Valley, but right here in Chicago. There's a lot of VC money, and it's becoming a place where entrepreneurs, want to start a business. Chicago is a world-class city, lots of great things to do, lots of talent, but especially for IT talent, it's becoming, very competitive. The wages are going through the roof, and you've got to have a good story to tell. If you're a crack software engineer, you want to go solve interesting problems, you want to build new technology, you don't want to work on old stuff, and you want to use the latest, greatest tools because that's the best thing for your career. So we're fortunate in that we spend a lot of money on technology. We're building lots of new stuff, and we think it's the kind of place where people want to work, but it's tough, And I would also tell you, to your point about Chattanooga, companies in Chicago are trying to import talent from the collar states, Indiana, Ohio, Michigan, Wisconsin, because they can't find enough labor, here in Chicago. So I would think that it would put a strain on some of these other communities, where, Chicago-based companies are trying to steal their talent.
Yeah, if you no longer have to be geographically defined, someone can work from home. It sort of changes the game for smaller communities like ourselves, where if you do lose a source of talent, it can actually have a pretty big impact, whereas a bigger market maybe to absorb it. Doug, you mentioned Chicago being the home of a lot of the technology industry. It's also a big intersection of technology and freight. Two of the most successful freight tech companies are Project 44 and FourKites, both based in Chicago. I'm curious, when we think about visibility, both in the visibility and transparency space, I'm hearing a lot of the folks, a lot of executives like yourself talk about that's no longer optional. You have to provide visibility and transparency through all breadcrumbs of a transaction. Can you talk a little bit about that?
Yeah, I think over the last 2 years, maybe, we've seen an acceleration in the adoption of technology by shippers. I would have said before that frankly, most of the big transportation companies were ahead of the marketplace. Because if you think about it, a lot of shippers, the transportation department is the last one to get access to capital and technology, and it's always kind of lagged probably other areas of their companies. But in the last 24 months, we've seen companies much more willing to adopt technology and to your point, even demanding it. So today, there's lots of large shippers that want near real-time updates on every single shipment that you're moving for them, and it's not uncommon to have an API connection with a shipper, and they demand an update every 15 minutes, and if you don't do that, you're going to get a bad score on your scorecard.
You think it's basically no longer an option? You have to have it to participate in the bids.
Well, it's a fragmented market, so there's clearly lots of shippers that don't have those demands. But if you want to play with the big dogs, I would say absolutely, it's a condition of doing business.
Now, Doug, Echo's historically had has worked a lot with small, medium-sized shippers, a lot less concentration in the larger shipper community. Is that still the case for you guys as you continue to build out your business and grow it?
No, not really. I would say that if you looked at our business, LTL certainly has a small shipper focus because larger LTL shippers are generally going to deal direct with a carrier and don't need a third party in between. Not always the case, but generally the case. But when you get to truckload, by definition, it's kind of the opposite. It's the larger truckload shippers that can only manage so many relationships with asset-based carriers, and they got to fill in the gaps with third parties like Echo. And so, in particular, as we've grown our truckload business, we are, operating with a lot of Fortune 100 companies, and we're in those routing guides, and as is typically the case, if you break into, let's call it a Fortune 100 truckload shipper, and get into their routing guide for the first time, you're usually going to get a few lanes and an opportunity to prove yourself. But as you prove yourself, as you do a good job, you're going to get access to their spot market freight. And then next year, when the bid comes out, you get the RFP, and plus you've got a working relationship. You're going to get the opportunity to bid on more lanes, and they're going to be willing to give you more lanes because you've proven your service capability. So I would say in recent years, we've had a lot of our growth, and probably most of our growth has actually come from larger shippers.
So you're saying a lot of is there a construct in the market? I know last year during COVID, the larger shippers were predominantly the winners over the small ones because they had more sophisticated supply chain networks. But what are you seeing in a post or a recovery market? Are you seeing small businesses also and small shippers also do well, or any difference between what we're seeing from the large enterprise shippers and the small ones?
Yeah, I would say if you went back a year ago last summer, the small shippers struggled because they depleted their inventories and they couldn't restock fast enough. If it normally took them 4 weeks between the time they placed an order with their suppliers and it landed on their dock, it was now taking 8 or 12 weeks because their suppliers were backed up, especially if the products were originating, in Europe or Asia. I think what that's caused is for those smaller shippers to take on bigger inventories. So I don't think they've necessarily got any more sophisticated in managing their supply chains. They're just carrying more stock. And I think the reverse is true with the larger shippers that, we saw them get very creative, especially when you had the port congestion on the West Coast. We had one customer who is a big supplier of Walmart, and, they needed to get their product into 42 Walmart distribution centers. And, they were working with us to figure out how to bypass their own DCs and go directly from, the Inland Empire in Southern California, to 42 Walmart DCs to satisfy one of their biggest customers. So we've seen a lot of creativity. We saw, again, with the port congestion, people going into Vancouver and Seattle to try to bypass LA Long Beach. And so, it's a tale of two-size shippers.
Is there a risk, though? This is something I've been sort of thinking a lot about, is because you have such tight inventories and you have shippers that are sourcing products from multiple vendors that perhaps they didn't before and from multiple locations around the world, is there a risk of us having a hangover from all this activity once the economy gets on a solid footing and we start to rebuild inventories? Is there a risk of everything slowing down, or do you think that this cycle is going to be pretty persistent?
I don't know if I know the answer for sure. I have a couple of thoughts, though. One of my thoughts was I think one of the things that caused the surge in freight was the fact that people weren't going on vacation, they weren't taking the cruise, they weren't going to the movie theater, they weren't going out to dinner. And what they were doing was sitting at home buying more stuff on Amazon, right? So I think that benefited the freight industry. As those people get back to normal, are they going to now buy less stuff on Amazon and spend more of their money on services and vacations and travel and some of those things? So that could be a detractor that will, it helped us on the way up and maybe it'll hurt us on the way down. So that's one input, I think. But the other one is, if we get an infrastructure bill and we're going to be spending whatever the number is, trillion and a half dollars on infrastructure, that's a lot of freight, ultimately. And so that's going to heat up a certain portion of our economy and certain shippers, and that's going to put a strain. You think about all the stimulus money that we've been seeing, and as you know, when you inject money into the economy, there's a multiplier effect because when I get a check, I'm going to go spend it, and then whoever I spend that money with, they're going to go spend it, and so that money has more value than the face value. And I think there's a lot of the multiplier effect going on in our economy right now as we've had all this federal stimulus and unemployment money. We also know there's a lot of people sitting at home right now because they're making more money collecting unemployment than they would be, driving a truck or working at Burger King or whatever the case may be. But eventually they got to go back to work. So I just think there's a lot of mostly bullish things. People in this industry, as you know, especially the investor community, always worry about where are we in the freight cycle, and if this is good as it gets, when does it start getting bad again? And normally, you could probably figure that that's somewhere in the next 12 to 18 months, a true story. But I almost think that the conditions we see right now are going to persist, well into 2022 and maybe beyond, because I just don't see anything pulling the other way, other than maybe the shift of discretionary spending going from products back to services.
Yeah, it's anyone's guess. I mean, we all have sort of our own thoughts, and I think the market everyone's a little paranoid because we saw there was 5 cycles in the past 5 years, or 4 cycles in the past 5 years. You get a lot of it's a pretty gut-wrenching experience to go through those cycles. You certainly
we saw an entire cycle last April and May.
Oh, I know. In really 2 months or a month and a half, it was sort of a super cycle, and it's continued on since then. So a lot's going on. Doug, you're a student of the market. You talked about investor sentiment. We at FreightWaves can't keep up with all the deals that are getting funded in venture capital, especially around supply chain, because that's where we tend to focus. But there's also sort of run in the equity markets. I also know you dabble or have dabbled in the past in crypto. What do you take of all of this stuff that's going on? I mean, certainly some of it's Fed stimulated, but what is your view on capital markets?
Well, I'd like to put a gag on Elon Musk because he's killing my crypto portfolio.
Yeah, he was not good for crypto, has not been recently good for crypto.
I'll tell you what, there's a lot of money out there. The private equity firms, the VCs, they continue to raise new funds. They're trying to put that to work. You've seen what's going on in the SPAC market. The SPACs were very sexy in 2020, and then I think that's been overdone a little bit. Now there's a lot of SPAC money looking for a home. So you've got all this money in these funds that needs to get put to work. Meanwhile, debt is still cheap. It's, you can raise capital with very low interest rates on the debt side. There's all this equity capital that's looking for a home. And so, we see valuations on private deals that are as high as they've ever been. And they're fueled by lots of capital and lots of access to cheap debt. And, it's an interesting time. And I don't know what's going to make that change unless it's higher interest rates or a softening of the economy. But it's hard to predict that.
Doug, is it hard for Echo to look at valuations and dip your feet in the water in terms of acquiring businesses because it is so inflated?
It is because, as a public company, we can look at having 3 or 4 times leverage. That's acceptable to a institutional public equity investor. Whereas a private equity firm will put as much leverage on a business as they think the business can stand. They don't want to put it at risk, but the more leverage they can put on a deal, the better their ROI, right? So it is hard. So for us, tuck-ins are still relatively easy for us to do. It's just that they don't move the needle as much. But when you look at larger transformational deals or adding new capabilities, if the deal is big enough to be a platform company for private equity, now you're talking about, an auction process where, we're seeing 13, 14, even 15 times multiples and 7 times leverage. Yeah, we can't compete with that.
Yeah, I've heard that talking to venture capitalists that in the M&A market, it's typically sponsored to private equity. There hasn't been, with all of the deal activity that's happening, there isn't a lot of M&A happening because companies just can't stomach the valuations. There's a disparity between the private markets and companies with an established investor base that's really sort of drug it down. Does that change over the next year? Do you think we'll see the days where companies like an Echo or others will start being more acquisitive in the logistics space and buying more mature brokerages?
Yeah, I mean we're actively looking right now, not necessarily at pure brokerage. I mean, I think for us, when we were younger in our life cycle, it made sense to buy brokers because it gave us density and scale and geographic coverage. The hazard with buying a brokerage is that it conflicts with your existing book of business, right? So, if I'm doing business with Anheuser-Busch and I buy another company and they're doing business with Anheuser-Busch, now I've got 2 salespeople that I've got a referee, and then the same on the carrier side. I've got 2 different carrier reps that are dealing with the same trucking company and they get commissions. You've got to deal with that. The other thing is that buying a brokerage in our current situation is that it doesn't really give us scale that we don't have. We feel like we have adequate scale to be competitive with anybody in any lane. So as we think about M&A, we're looking more at, what additional capabilities can we add that are fairly close to our core. They're not asset based, but they maybe diversify us a little bit out of the freight cycle. And, we've looked at some technology businesses, we've looked at some data science businesses, we've looked at some consolidation businesses. And so, there are a lot of things in adjacent spaces that are attractive to Echo and maybe not big enough to be on the private equity radar. And that's probably where we'll have success in the short term. And then, more transformational deals, if you were thinking about like a freight forwarding business or a final mile delivery business, those are interesting too. But I think in this current market environment, those would be tougher to do.
What do you think the digital brokers that have gotten, if just arguably in looking at the Echo balance sheet and income statement, what public multiples are, and then, through our own research, looking at private multiples, it's a very big disparity between the digital brokers and traditional, or I should say established players. What do you think the game ends for? At some point, the investors in those digital brokers have to exit. So where do you think it ends up? Do you think it continues to be a sponsored deal where it just gets passed from sponsor to sponsor until the business gets to a certain scale and then it becomes an interesting asset for someone like an Echo? Or where does all that go? Because putting a high valuation on a business is great. It looks great on paper, but we all know that founders don't get paid until they actually exit.
Yeah. Well, Craig, I know you understand the VC game, and they're different type of investors than private equity, and private equity are different types of investors than public equity investors, and they all have different risk tolerances. The VC investors are looking for astronomical growth. They want to see disruption. They want to see disintermediation. And if they believe that a particular investment will accomplish those things, they'll pay up. And they protect themselves with preferences, liquidation preferences. that sort of protect their downside. So, if you apply conventional wisdom to VC valuations, it's not always apples and apples, and they're pretty smart guys that know what they're doing. So, I don't try to diminish that at all. I do think that there comes a point where they have to get profitable. If they want to continue to either raise capital or they've got to have a story to tell, right? So we saw some market share grab a couple of years ago. Now it appears that there's more of a focus on getting profitable. The path that Echo took, and I don't know if we would do it the same way if we started over, but when we took the company public in 2009, our revenue was $260 million. Now that's pretty small for a public company. And our story to investors was, we're going to be a high growth company and we're going to be profitable. And I remember one time in an investor meeting, the investor said, "Why do you tell that story?" And I said, "Well, that's what we're trying to do." And he said, "Yeah, but you can't do both." He said, "At your size, you either have to be a high growth story or a profit story. It's hard to do both." And I think in retrospect, he was right. If you look at the playbook for most tech companies, it's grow as fast as you can, take as much market share as you can, and then turn up the price dial at a future date to get profitable. That's what Amazon did, right? How many years was Amazon unprofitable? And investors gave them a break because they knew the day would come, and lo and behold, it did. But I think it's just a different approach. And I think that if they continue to have success, both in growth and eventually in profit, and they get to a scale, they'll find an exit, whether it's an IPO or a merger or something of that sort. I don't think all of them will make it, but I think the good ones will make it.
Yeah, it's funny you mentioned liquidity preferences, because I think I talk to a lot of people who've never raised capital, who sort of read headline numbers, and they don't understand what valuations mean and liquidity preferences. And it's often missed that investors are able to protect their downside, but they have optionality in many ways on the upside. And I think that's missed, because you and I could go start a business tomorrow with zero revenue, put $1 billion valuation on it, and it would look really good in headlines, but it really doesn't mean that it's worth $1 billion. Appreciate it. So
you're right, because if it doesn't work out, you're not going to make a penny, right, Craig?
That's exactly right. In fact, when we just did a small round a few months ago, it was unsolicited. It was a $16 million, and it was a small round relative to how much we've raised. And people were curious why it was a small number. And frankly, because we don't need a lot of money. Why would we continue to stack money in front of me and the management team here if we don't need it? It doesn't, sort of nonsensical. So there's a lot of confusion in venture capital, and it is interesting as companies go public. You mentioned the SPAC market. I don't know what's going to happen there with all these SPACs that have raised money, which have raised a significant amount of capital. But it's going to be a lot to watch, Doug. So we'll see where that ends up. I've always asked this every time you've come on to make a prediction for the next cut. I typically ask for 5 years, but because we're in these sort of super cycles that are measured in much shorter time frames, what does the next year look like for just overall? Any predictions you have?
For Echo or for the industry?
Just overall, any bold call?
I just think that we're going to surprise everybody with how long this cycle lasts. I think people have come to expect that the cycles last about 18 months and then revert to the mean or go back to the trough or whatever. And I just think that, as you indicated with your earlier question, it's different this time, largely because of the driver shortage. I think autonomous vehicles can help, but I think those are a lot farther away than people think. For not for the technology, but because for acceptance. I think you're not going to see trucks driving themselves until you see a lot more cars driving themselves. And I think the railroad industry is going to, when it looks like it's a reality, will step up and oppose it through their packs and things that we've seen them do in the past with longer vehicles. So I think the autonomous vehicles will continue to play out, but won't really be a story until, I don't know, 5 or 10 years. I think demand's going to stay strong. I think the driver supply is going to crimp the supply of capacity, and we're going to continue to see these tight market conditions for longer than we're used to.
Well, good predictions. I hope that you're right for the sake of the industry. It would be great to see a multi-year cycle where everybody wins. And I think what's often missed in this, the driver shortage or driver squeeze, whatever the term you like, is that ultimately that means higher wages for drivers. It makes it tougher, but it means higher wages for drivers, and then ultimately means higher rates for companies like Echo and other participants in the market. And we'll see where all this ends up. Well, Doug, really appreciate the time. Best of luck in finishing out the year, and we look forward to seeing you again.
All right. Well, thanks, Craig, and appreciate you having me on the show.